Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. The channel continues to grow because of people like you, and I really do appreciate it. For those of you who may be stopping by for the first time on this channel, we focus on dividend growth investing. It's not rocket science, in my opinion. The best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks in growing companies with positive cash flow and enough free cash flow to cover the dividends. Companies with a high return on their invested capital, growing revenue, expanding margins. I utilize both a dollar cost average approach, consistently investing into the stocks within the portfolio every week. That's what this video is. This is our portfolio update video. We do this every Sunday. We are going to cover the $708 in new capital that we added to the portfolio, any options I was in, any dividends received, and if I have any sales in the portfolio, I will cover those as well. I think it's very important for those of us in this space to be transparent, show you what we are doing. I do it out in the open. I do not have a paid Patreon account. I'm not sending you any sites to sign up to or any newsletters to sign up to. But if you would like to help out the channel, the way you can do that, it only takes a couple seconds of your time, doesn't cost you anything financially. Hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed. Join us on this journey to financial freedom. Join the Vested Interest community. Click that subscribe button down below. Hit the notification bell so you're notified whenever I put out any new content, along with this portfolio update series. Again, every Sunday we do this one, but I do a stock pick of the day video series Monday through Thursday. We take a look at a company's stock that's pulled back on the day, or one that you as a viewer or a subscriber has recommended, and we look at the stock that's pulled back, run it through my screener, see if it makes it onto my watch list. Now, if it does make it onto my watch list, that does not necessarily mean I'm interested in buying. It just means I'm interested in doing more of a deep dive into the financials of the company. So again, if you're interested in that type of content, you're a dividend growth investor or investor in general, go ahead and hit all the buttons down below, and there's the thanks button down there if anyone would like to buy me a cup of tea. I do not drink coffee, but that would be a way you could help out the channel financially as well. Now, let's get into the first new activity of the week. Last Monday, on the 2nd, we did throw out, well, we threw out several more than this, but these are the two that happened to hit. We threw out two different covered calls here. We received $104.86 in options premium. They both did expire out of the money, so we kept the positions, and we can try to do it again next week. Now, the two contracts we were in, it actually was three different contracts. That's what the -3 represents, the contracts. And those three contracts represent 300 shares. Each one contract represents 100 shares, so you need to own 100 shares or more to do what are called covered calls. They're covered because you own the shares already. So we did that on Omega Healthcare Investors, ticker OHI. This is a REIT out of the real estate sector. Medical sector is what they're covering here as far as the REIT overall. But we did a covered call. So again, that means we own 300 shares of Omega Healthcare Investors with a June 20th expiration date, right? So this one has not actually expired yet. This will expire on the 20th, and it was a $38 strike price, right? And for that, we received $73.40 total options premium. So we'll have to wait to see this if this one expires out of the money because it's not quite expired yet. But the next one is for Kroger. This is one contract, so 100 shares of Kroger, ticker KR, out of the consumer staple sector with a June 6th expiration date. This was Friday, so this did expire out of the money, and we had that covered call with a strike price of $69. So Kroger didn't run up above $69, so we keep those shares, and we also keep this $31.46 in options premium. So we'll have to wait to see how OHI shakes out. If it does hit $38 or above before the June 20th date, these shares would be called away, right? So that one's still on. Kroger expired out of the money on Friday. But again, we received this $104.86 already, and this is part of that $700 and change that we invested into the portfolio this week. Now, dividends. We received several dividends this week. On June 3rd, the first couple dividends rolled in from a couple different companies. We received $238.34 total in dividends. Now, one of them was from a position we've sold out of. So American Waterworks, ticker AWK, we did sell this position, I think last week or the week before, for around an 14 to 18% profit right in there. I can't remember exactly what it was. You'd have to go back to that video and see, but it was a nice double-digit profit on that one, but we still received the dividends. So $97.08. This again, since we are out of this position, it doesn't drip back into it. So this would be part of the funds we reinvested this week as well into other positions. So we don't hold this one anymore. We may look to get back into this if it was to drop back down to the one teens. I think 119, 118 is where we were buying it about a year ago. So if it was to drop back in there, we might look to add it back into the portfolio. But for now, we've sold out of this position. The next one up was Enbridge, ticker ENB. This is out of the energy sector. American Water Works was out of the utility sector, if I didn't mention that. Enbridge is also a foreign company. This is a Canadian company. So there are tax implications here, and I wanted to walk through that. So as you can see, the total dividend paid out was $166.19. Now you can see cash movement here. This is the taxes. My brokerage takes out the taxes right away. They do it automatically for me. I don't have to worry about it at the end of the year or tax time. They are taking the taxes out. Now you need to understand how, if you own foreign companies like this, you need to understand what your brokerage account does. Some of them take the taxes out, some of them do not. If your brokerage account does not take the taxes out, you are going to have to account for those whenever you do your taxes, right? Again, my brokerage takes it out. So as you can see, $166.19 total dividend paid out minus the taxes, $24.93 because it's a Canadian company. So that leaves $141.26 to be automatically reinvested. The DRIP does count here after they take the taxes off. So that $141.26 picked up 2.9928 more shares through the DRIP, which stands for Dividend Reinvestment Plan. Automatically, whenever any company pays out dividends, in this case, minus the taxes, the DRIP gets sent right back in and buys more shares. Now, the Enbridge shares, the $141.26 and the 2.9928 shares it adds an additional $8.14 in additional passive income over the next calendar year. So again, nothing reinvested on American Water Works. This is part of that 700 and some change that we reinvested ourselves, but Enbridge automatically gets reinvested and picked up 2.9928 more shares. Next, we received on the 2nd, I don't know why I put the 1st, it should be June 2nd, dividends from Kroger. So not only did we run options on Kroger, we got dividends from Kroger, and it's almost about the same. I think it was $31 and some change we received in options premium and $32.90 in dividends. So it almost like we doubled up on dividends this week for Kroger, ticker KR, out of the consumer staples sector. Paid us $32.90 on the 2nd, and that $32.90, again, we have the DRIP set, so it went right back in and picked up 0.48248 more shares of Kroger, so some fractional shares there, and that 0.48248 shares adds an additional 61 cents in passive income over the next calendar year. Now we get into the first new capital added to the portfolio. We added $232.98, and keep in mind that some of this is part of the options premium we received, as well as the other one that we did later in the week would be the remainder of the options premium, as well as the dividends received from American Water Works. Since that wasn't automatically reinvested, since we sold out of that position, we reinvested that ourselves. But anyways, on June 2nd, we invested $232.98. With those funds, we picked up one share of Schwab Strategic Dividend Growth ETF, ticker SCHD, picked up that one share at $26.15. We added to our Comcast position, ticker CMCSA. This is out of the communications sector. Picked up those 2 shares at $34.31. Added 6 more shares to our Vale. This is a mining company out of Brazil, and ticker VALE, out of the materials sector. We picked up those 6 shares at $9.26. And we added 2 more shares to our Occidental Petroleum position, ticker OXY. This is out of the energy sector. Picked up those 2 shares at $41.33. This $232.98 invested plus the new shares it added an additional $9.99 in passive income over the next calendar year. Last up here for the week on June 6th, this was Friday, we added $475.27. And again, some of this, we're trying to invest about $500 a week, $550 a week, and then use options premium and some of the dividends to help increase our passive income added. So again, my funds out of pocket around $350 plus the American Water Works plus some of the options premium is this $475.27 total. With those funds, we added to our Vanguard's total stock market ETF, ticker VTI. And this one and SCHD, they're part of our weekly buys. I buy these every week, regardless of the market. If the market's pulled back, I buy. If the market's running up, I buy. It doesn't matter. I just dollar cost average into this every single week, regardless of what the market's doing. So 1 share to our Vanguard total stock market ETF, ticker VTI. We picked up that 1 share at $294.77. And I think that's the most I've ever paid for VTI. It definitely has rebounded. The overall market has rebounded. A lot of individual positions have rebounded as well. That is part of the reason I have backed off. I was adding about $1,400, $1,500 a week to the portfolio. Again, I've backed off to about $500, $550 a week of my own dollars out of pocket, plus reinvest in dividends. Plus, if I get any options, I'll obviously invest that as well. The options plays are a way to juice up the portfolio a little bit. It's like extra dividends. Obviously, we don't hit on them every week, but whenever we do, it gives us a little bit of extra cash. Now, 3 shares added to our Schwab Strategic Dividend Growth ETF, ticker SCHD, picked up those 3 shares at $26.54. And again, SCHD and VTI, SCHD, and VTI are just part of our weekly buys. I'm going to pick up at least 3 shares. You saw I picked up 1 share earlier in the week. Maybe as I pull back on how much I invest, I may lean heavier into SCHD overall. And some of the positions, as they pull back, I'll add to and nibble on here and there. But wrapping up the rest of the buys here, we added to our HP Inc. position, ticker HPQ. This is out of the information technology sector. Picked up 4 more shares at $25.22 for that one. And the $475.27 in new capital added, as well as the shares picked up, added an additional $11.55 in passive income. So total invested this week was $708.25. Again, part of that was options premium, as well as the American Waterworks dividend that didn't get automatically reinvested, but that's okay. We want to, if we can, increase that with the options premium. So out of pocket was about $550. The rest came from the portfolio overall. Total invested $708.25. Total passive income added $30.29 in passive income over the next calendar year. Next up, we'll run through the portfolio weights here. As you can see, communications makes up 10.52% of the portfolio. Consumer discretionary, I really like Tractor Supply. I'm really considering adding Tractor Supply into the portfolio here. I may do that over the next couple of weeks. If it remains down near its 15% of its 52-week low, which is where it is right now. Really like the company. Was in there actually recently getting some ramps. My father-in-law gave me a new mower that he no longer uses. New for me, old for him, that he no longer uses. So I had to get some ramps to get it up into my truck. And Tractor Supply was the only place. Went to Home Depot, went to Lowe's, that had one on the shelf that I could buy. So that's where I went. Not that that's the only reason I like them. I do feel like they offer a little bit something different than Lowe's and Home Depot do. And they're a niche company that seems to be doing pretty well. And I don't have anything currently in the consumer discretionary sector outside of my positions with VTI. But anyways, consumer discretionary is a 0. Consumer staples at 8.64% of the portfolio. Energy at 10.18%. Financials makes up 2.40%. I'd love to add an American Express or Visa on a big pullback, but those seem to be running up currently, so we'll have to wait on that. But Ally is currently the only position there in financials at 2.4%. Healthcare makes up 18.36%. Industrials makes up 6.5% of the overall pie. Technology at 20.01% of the pie. Materials at 2.31%. Utilities makes up 3.93%. REITs and real estate at 5.96%. Looking for a bit of a pullback on Vici. Love to add to that one. Right around $30 or under. So looking for a pullback there. Hopefully we get one so I can add some more to that position. And ETFs at 11.19% is starting to become one of the larger positions in the portfolio. Eventually, ETFs will overtake and be the largest position in the portfolio by design of me buying VTI and SCHD every single week. Over here to the right, you see these same percentages broken down that match the pie here, as well as the dollar amount allocated to each. All right, here it is. I think it's important for those of us in this sector to show our portfolios every week so you can see that we're not just talking about investing. We are putting our money where our mouth is and doing it as well. So that's why I show mine every week. I want you to see the ups and downs of the market, the ups and downs of holding individual positions. and that there is going to be times where you are going to see pullbacks. That should not be a reason to sell. If you've done your due diligence, you've done your research, you understand how to research companies, fundamentals, look at their balance sheet, their income statement, stuff like their debt to equity ratios. Are their margins expanding? Is their revenue growing? Are they paying down debt? Are they making acquisitions? What does their free cash flow look like? How are they looking price to book compared to other companies in their sector? How is their price to sales? Are they within 15% of a 52-week low, which is where I like to buy them? Are they setting a new 52-week low? What potentially is the reason for that? Have you done a discounted cash flow analysis to understand what you may, or a range you should be paying for a company? And if you don't understand all that, there's nothing wrong with that. You can still invest. Warren Buffett would recommend the S&P 500, and for you to just buy every week, regardless, just dollar cost average into it every week, regardless of the market, and you will do better than 90%, 99% of the people out there who are not investing. And that would be an easy way to get around. You don't have to buy individual companies. Just stick to ETFs or index funds. Pick one you like. Again, Warren Buffett would recommend something that matches or tracks the S&P 500, something like VOO, which is Vanguard's S&P 500 ETF. There are several of them out there. Schwab has one. I know there are other funds out there that track the S&P 500 as well. So find one that you like with a low expense ratio. You don't want to pay someone to manage your money. That's why I like individual stocks. I'm not paying anyone to manage it. Obviously, I own VTI, which is the total stock market, and I own SCHD. So those are the two ETFs that I have chosen. There are a lot of them out there that you could look at if you don't want to, again, do the research into individual stocks. But I do show my portfolio every week. So again, if you're interested in that type of content, you want to see how a real portfolio is built out over time, the ups and downs associated with it, hit that subscribe button, hit the notification bell, and join me on this journey to financial freedom, because that's what I do. I show you out in the open what I'm doing. So hopefully you can learn from my mistakes. And again, hopefully it helps some of you out there to understand there are going to be drops in individual stocks and the individual market. I mean, VTI was down here 8-9% not too long ago. SCHD is still down, right? So even ETFs are going to pull back. And in my opinion, that's the time to be adding a little bit more. Whenever you see that red, well, if I thought SCHD was a good buy at $27.47, it should be a better buy at $26.54. Same thing with Comcast. If I thought it was a good buy at $39.30, I should think it's a better buy at $34.70, right? So on and so forth. You can run through where you see the red. Again, hopefully this gives some of you out there who are on the fence thinking about investing, or maybe just getting started invested, hold those positions. If you understand they're good companies, you've done your research, and you bought them at good prices, don't sell them just because they're down by 11% or 14% or 16%. That's the time I'm adding more, or 10% for Occidental, right? 14% for Pfizer. I'm down on several positions, but I consider all of them a buy. I think the only one I haven't really been adding to is Pfizer, and that is only because it's one of the larger positions in my portfolio already. So I'm just letting the drip do its thing. All right, I'm going to get off that soapbox. Hopefully you understand why I show this every week, and hopefully it is beneficial to some of you out there. Here is the ticker, all the different positions in the portfolio here, total shares, current price. All of these numbers will be as of the close of business on Friday. Market value here, average cost per share. That's my average cost per share. This does include reinvested dividends. Same thing with purchase price, my out-of-pocket cost plus reinvested dividends. So it adjusts as those dividends get reinvested as I add to the position. Total return here, whether I'm up or down, you're going to see it. Obviously, if it's red, I am down. Percent return here, same thing. Red, I'm down. Green, I'm up. The more green, the more I am up. Biggest winner right now is AT&T at 69.97. Kroger has started to pull back a little bit, still up though at 46.09%. That's one we did options on, as well as receive some dividends this week. I would love to add to this position, but I need it to be back here in the $50 range, right? I'm under that at 45.28, but I want this back in the $50 range before. So I don't mind the pullback, actually, because I'd like to add to the position, but I feel like right now it's a little outside what I'm willing to pay. What sector each company falls in here, whether they're a quarterly, monthly, semi-annual payer. I am highlighting the positions as they raise their dividends. You'll notice UNH recently was highlighted here this past week. They raised their dividend by 5.2%. Current yield here, my yield on cost here, portfolio weighting here. I do have a rule in the portfolio for positions. I do not want any one individual position to be more than 10% of the portfolio. I do not want any one sector to be more than 20 to 25% of the portfolio. If you recall from the previous slide, currently information technology is at just over 20%. That doesn't mean I'm going to run out and sell positions. It just means I'm going to watch what positions I'm adding to. I did add to HPQ this week, so that's part of the reason it bumped back into the 20% range. I'm not going to back off adding positions that are down, but positions like Google that are up currently, positions like LRCX, Lam Research that are up, I won't be adding to those positions. And just because they're up does not necessarily mean I'm going to be selling to them, but it means I'm going to back off that sector a little bit, not add as much to it. Except right now HPQ is down. I'm going to take advantage of that while this position is down, probably maybe nibble a little bit and add more. But overall, if it was to get above 25%, I would probably back off it altogether. But 20 to 25%, I don't want any one sector to be, and I don't want any one position to be more than 10%. That is a bit of a rule I have in the portfolio overall. Estimated annual income here, payout months here, and sometimes these do shift a little bit. If a dividend was to pay out early and it pays out right in the beginning of the month, it might slip from April to May or February to March, something like that. So these are the estimated months that they pay out again. Sometimes it slips 1 month forward or 1 month back, depending on where their payout is. It might fall on a weekend or something and pay out, like I said, in the following month or before that weekend happens. It does happen from time to time. Dividend growth year over year. This does adjust, as you can see here, UNH right there. I did adjust there. It was a 5.2% raise. I think before this, last year, it was around 11% raise. So this does adjust as they adjust their dividend payouts. 15% of a 52-week low. I use this number as a high water mark. We talked about this a second ago. Let's look here. Kroger, for example. We'll go back to that one, right? I'd love to add this position, right? It's one of my smaller positions in the portfolio. Currently makes up 1.84% of the portfolio overall. I want to add to it, but I really want the cost basis to be under $50.03, and it currently sits below that. So I'm waiting for it to fall back into the $50 range or under before I add, because I don't want to bring my average cost per share up too much, and I want to keep it below 15% of a 52-week low. Now, total shares, 7,454.299 shares. Current portfolio is worth $370,778.77. I do have $340,351.94 into the portfolio out of my pocket. That does include reinvested dividends, and I say out of pocket because if I turned off the drip, those dividends would go into my pocket, and I'd be able to use them to pay bills, take my wife out to a date, do whatever I wanted with them. But right now I do have the drip set, so automatically those dividends get reinvested. So this is part of the purchase price and what I consider out-of-pocket cost. Total return, $30,426.83. I am up 8.94%. I do not focus on this as much. I know right now there's a lot of people talking about total return. The only thing that matters is total return. I don't necessarily agree with that. Total return is nice to see, but unless you are planning on selling positions, total return means nothing. Absolutely nothing. The only way you get this return, well, there's a couple ways you can get it. You sell out all the positions, right? If I sell all these positions, I'm walking away with $30,426.83 more than I had before. Now I'm gonna have to pay taxes on that, obviously. Most of these positions I've held for more than a year, except for Google. It's one of the newer positions. Lam Research as well. I haven't quite held these for a year yet. So I would pay, taxes on that based on how long I've held the position. Some would be more capital gains than others. I'd have to pay capital gains tax on it, again, depending on how long I've held the position. And this 8.94%, again, doesn't matter unless I sell everything. So if you're focused on total returns, do you plan on selling all your positions at some point? That's the only reason to focus on total returns. The other way that you can get money out of stocks focused on total return, you could leverage them, right? You could leverage them for margin, or you could take loans against them, but you're gonna have to pay those loans back. So again, you would eventually have to sell the positions or continue to collect dividends to pay down those loans. Either way, total return doesn't really matter, again, unless you're looking at selling the positions. So if that's your focus, there's nothing wrong with that. You can look at it, and I'm going to sell positions, live off 4%. Some people like the 4% rule where they're selling off parts of their portfolio and living off 4% by selling positions. I am not focused on that because I want to live off the dividends and not sell positions later in life, right? Here's the sector. We'll talk about it more here in a second. Sector each position falls in. current yield is 3.561%. My yield on cost is 3.88%. And this is what I focus on. That's why it's circled in red. The dividends, the annual dividends received, paid out by all the positions in the portfolio, and it continues to grow week over week, month over month, quarter over quarter, year over year as I add new capital on a weekly basis, as the positions in the portfolio pay out dividends, and those dividends get reinvested buying more fractional shares or shares of those positions. And as UNH did this week, as the companies raise their dividends, that will increase this as well. And it currently sits at $13,205.12. So growing nicely, really nice to see this go up week over week, month over month, quarter over quarter, year over year. Dividend growth did go down slightly to 5.89%. Again, UNH went from around 11% dividend growth to 5.2 in its most recent, so that did adjust this. And I will adjust this as the companies adjust their payouts. All right, that is really it for this one. I need to update this picture. We have the pool open. It looks a whole lot nicer than that, and the yard even looks a little nicer than that. Now, this was really early in spring, so I do need to adjust this and put another picture in for you so you can see what the backyard actually looks like. But as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. Drop a comment down below. Let me know what you think of the video. How is your portfolio doing? What have you been adding? Are you selling anything? What dividends did you receive? And are you running any options? And how is that going? We'd love to hear from you in the comment section down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Sorry we got this one out a little bit late on Sunday. I'm doing this Sunday morning. I have had a very busy week. My daughters are in sports right now. My oldest in volleyball, my youngest in flag football and football. So we have been pretty busy. Actually, I've got to finish this one up, try to finish up the yard before we run to another one of the girls' games. And they've been wrapping up school as well. So my oldest daughter was accepted into the National Honor Society, so we had that going on this week, as well as some other things for their school, trying to wrap up the end of the school year. So again, apologies putting this one out a little bit late on Sunday. Usually I get it out about 7:30, but we've been pretty busy, so I'm pushing this out a little bit later. Let me know what you think. Let me know what's going on in your portfolio, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion. Investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money. You should never invest any amount you are not comfortable losing. Always do your own research and invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor. For those of you who made it to the end, really do appreciate you watching. Don't forget to hit the subscribe button, like, share, drop a comment, all the things down in the bottom. They really do help out the channel. And again, thank you for watching to the end.